Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 Challenge, number 35. What are these things we call shares? What's it all about? So, well, let's dive into it. After our disclaimer, there's the facts, it's all about information. It is not advice in any of our sessions. So we hear this terminology being tossed around. You've got any shares? Should you buy some shares? Why don't you buy some shares? What exactly are we talking about here? What is a share? Now, a share is exactly what it sounds like. It is a share in the ownership of a company. So if you've got Commonwealth Bank shares, you actually own part of Commonwealth Bank. You can even go to their board meetings and put your hand up to make decisions, and so it goes on. Obviously, the number of shares would give you more power, so more shares, more control over the company. If you've only got a handful of shares, then you're probably a nobody as far as the shareholders are concerned. But indeed, you in theory do get to vote on people on the board and things like this. So you get to make decisions. You're actually part of the decision-making process of the company. Now, as the company makes profits, so in theory, you've got something like Commonwealth Bank makes billions of dollars, and then they pay their tax on the billions of dollars, as little as they possibly can get away with, and then of course they give the profit. The profits are split up between all of the shareholders, meaning that if you've got a lot more shares, you get a lot more bigger share of the profits. So it's per share. They give you a what they call a dividend, meaning it's a portion of the share, a portion of the profit that literally then relates to how many shares have you got as to what they're going to pay you as part of the profit. Now, there are things called franking credits, but I'm going to do a session just on franking credits. But just briefly, at the moment, what it boils down to is when you get your dividends after the company has paid tax. So if you receive a dividend, like getting interest from a bank account, it's income, you would get taxed on it. But because the bank or the company has already paid tax, you get a little thing called a franking credit. Say, hey, the company's already paid this tax, you don't have to pay as much tax when you get it. So it's just sort of offsets what tax has already been paid. And it can be a very, very effective way to receive money because it's very, very tax effective. But we'll go through that in another session. But of course, the profits may not be guaranteed. Obviously, the company A may not make any money, so there are no profits to distribute, or they did make some money, but they're going to feed the profits back into the company to buy new machinery or build a new building or whatever it may be. So just because a share pays a good dividend this year doesn't mean you're going to get a good dividend next year. Having said that, a lot of the big companies, pay regular dividends, and they know that if they stop paying dividends, probably people would get out of that share because people are relying on that income coming in. So a lot of the people have been doing dividends for a long time are very reluctant to stop them if it means that people would then sell their shares. But it's not guaranteed, that's for sure. Now you buy a share on what's called an exchange, so it's just like a clearinghouse, like going to the market online where you talk to these people saying, yep, I want to buy this share. They talk to the company they talk to someone else who's got some shares that you want, and when they want to sell it, they say, yep, I've got a buyer, and they do the transaction for you. That sounds all quite complicated. It's not. It's all just done on a system, on a platform, on a software where basically you just punch in what you want to buy, how much do you want to buy, how many shares, what dollar value, whatever, and you hit the button, and literally in about 3 minutes' time, you own those shares. And similarly, when you're trying to sell, just in reverse. Now you'll hear when you're talking about shares with various people, you'll hear this word bandied about called what is market capitalization, and they will talk about, have you got a big company, or are you buying a little company, and what defines a big company and what defines a little company. It comes down to what they are basically saying is the value of the company. How they value the company is by taking all the shares that are available and multiplying it by the share price. So a little example down the bottom there. There might be 20 million shares available for a particular company. The shares are $100 a share. Therefore, $100 plus 20 million shares is $2 billion. But of course, the number of shares varies from company to company. Some companies might only have 100,000 shares. And obviously, therefore, it just depends on what the price is of those shares as to what the value is. So just because a company's got more shares doesn't mean it's more valuable, and vice versa. Doesn't matter about the price. It depends on how many shares there are as to what the true value of the company may be. So it's just literally this, what's market capitalization, how big is the company? They literally just multiply the number of shares by the price. So you'll hear shares called blue chips. Are you going to buy some blue chips or not? A blue chip is really just one of the very, very big companies in Australia. So we're talking, Commonwealth Bank or ANZ Bank, one of the big banks, talking about BHP or Rio. We're talking about Telstra, Woolworths, all the household names. The big, big companies have been around and are worth a lot of money. And the market capitalisation for the blue chips generally over $2 billion. So the company's worth a lot of money. Now, the advantages of buying shares in a blue chip company, a big company, is the fact that it's very unlikely that Commonwealth Bank will go broke tomorrow. So it's like that safety factor of having a big company. Lots of information on companies like Commonwealth Bank. You'd literally Google and spend days looking through all the information that people and companies and people who assess these sort of things online. Bucket loads of information. So you could really go crazy trying to nut out, how is the company really doing if you're involved in that. It's part of an index. We're going to talk about indexes and index funds and all this sort of stuff in future sessions. But what it boils down to is if you're listening to, say, Alan Cole of the ABC News at night, and he said that the Australian market went up by 1.2% today. Well, when he talks about the market, he's usually talking about the ASX 200. And what that means is that's the top 200 companies, the biggest 200 companies in Australia, and what's their value total. So that's an index of the top 200 companies. It might be the top 500 companies that they talk about. But literally, that's an index of 500 companies. There is an index for the top 20 companies, and so it goes on. So it's just a guide as to a group of companies is what it's all about. But because people can buy an index, it actually helps the price of companies that are in the index. So if everyone wants to buy an ASX 20 index, and because that's quite a popular thing for people to buy, they're buying the top 20 companies, it means that if your company's in that index, then you're getting the benefit because someone's buying your company as part of the index. So generally speaking, can be an advantageous thing if your company is part of one of these indexes. Normally higher prices, but not necessarily. I mean, Telstra, sort of fluctuated around about the $3 to $7 mark. And there's certainly a lot of smaller companies than Telstra with much, much, much higher values. So not necessarily the case, but some of these big companies have got share prices over $100, which is fairly expensive for Australian shares. Low volatility. Now what that means is that usually the big companies, their prices don't swing up and down a lot in a day. So, they might go up and down by 1%, 2% or something like that. Very unlikely to see the share price move by 20% in a day. But that can certainly happen for little companies because there's not as many shares and you only need someone to buy up big and it can move the price quite dramatically. So blue chips, generally speaking, safer, more steady and lots of information, perhaps more predictable is possibly a way of thinking about it. Now the small caps, they call a small capitalisation, the smaller companies, but when I say smaller, they're valued somewhere there, between 300 million and 2 billion. So it's not really small. It's not like the corner shop, that's for sure. This is still a pretty big company. And even what they call the micro caps, the very small caps, they're still worth 50 million to 300 million. Again, it's not like the corner shop. These are still relatively large corporations in Australia. So it's very unlikely that a corner shop, even though it's a business, would be listed on the Australian market and you can buy shares, and it's usually usually a private company where you can't buy shares. So it's only normally the much bigger companies that actually offer their shares out for sale. The downside of having these smaller caps is the fact that there's nowhere near as much information available on them, because there's not as much interest in them, so people don't bother spending as much time putting information out there. Generally speaking, prices are lower because most of the stockbrokers, the people that guide other people on what they should buy and sell, it's just too hard for them to keep an eye on every single fund, and so some of these little companies, it's just ignored, so they don't get promoted, and so that can have an impact on their price and so forth. And of course, yes, higher volatility, because if it's a lower share price, just imagine you've got something that's 2 cents. The share price is 2 cents and it goes down to 1 cent. That's halved. That's a 50% move just by moving by 1 cent in price. So little cheaper stocks can actually move a lot more than our big chips. That's for sure. But we'll go through this in more sessions. But as I said, it just comes down to it's not the price that you've got to worry about, because you can just imagine it doesn't mean that if you spend and buy 5,000 shares, and the 5,000 shares are 20 cents each, so you spend $1,000 buying some shares, but you've got 5,000 shares in a small company. That doesn't necessarily mean that it's any better than purchasing, even just 15 or 20 shares of something that's worth $60 a share. It's the dollar value is still $1,000, but it can come down to how much does it move by. So a 10% move on a 20 cent share, it can be quite easy to do, whereas the same sort of movement on a $60 share. So it just comes down to, how much is it moving by? But of course, also, what is the risk? What are the chances you're putting the money into this thing? It's a smaller company, more chances perhaps of going broke, that you could lose all your money. But it's over time, the more we talk about this will all start to come together. But in theory, it doesn't matter what the price is. What we're looking for is what it's going to do in the future, is what we're looking for. No one can predict the future. Don't listen to anybody who reckon they know what's going to happen. That's for sure. We'll go through more all about these shares and other investments over the next few weeks, months, years, and into eternity.